What is business entity assumption? The business entity assumption states that a business is treated as a separate entity from its owner. This means that financial records are maintained independently and personal transactions should not be mixed with business transactions. So let's take an example. Johan and Zizan own a business together. Even though they contribute capital to start or run the business, these transactions are recorded separately from their personal finances. Any withdrawals they make from the business are also treated as separate from their personal income or expenses. This ensures transparency and proper financial reporting. Even if a bank loan is secured with personal assets, the business financial statement will still treat Johan and Zizan Carpet as a distinct entity. This maintains the integrity of financial record and helps in proper decision making.
So the second measurement elements of financial statement is historical cost measurement. So the definition of the historical cost measurement is the method used to record and value assets at their original purchase cost rather than its current market value or fair value. This method actually relies on the actual amount paid for the assets at the time of acquisition and including any cost directly related to obtaining the assets. So let's take a look at this case. So in this case, the building price is about 150,000 ringgit and the delivery van is cost about 70,000 ringgit are recorded at their original purchase value rather than its current market value. So despite depreciation being applied, which is 12,000 ringgit for the delivery van and the 10,000 ringgit for the building, the business continues to record the value at their original price, which is 150,000 ringgit for the building and 70,000 ringgit for the delivery van.
Next, I'm going to explain about the accurate basis of accounting. Accurate basis of accounting records the revenues and expenses when they are earned, or inaccurate, regardless the cash is paid or received. They use these measurements to ensure that the financial statement reflects the actual financial position of business. Now, let's apply the accurate basis of accounting into the statement. The statement has stated that Johan Carpet's business sells carpet on cash and creditors, which means the revenues are recorded when the carpets are delivered, even though the payment have not received. This follows the accurate basis of accounting principle, which means the transactions are recorded when they occur, not in cash exchange. Other than that, the statement has stated that Johan Carpet's transactions are recorded in Ringgit Malaysia. To conclude that, Johan Carpet follow the fundamental accounting principles, particularly in accurate basis of accounting, to record when the transactions happen rather than the payment has received. They also apply depreciation, but see, they keep their assets into their original cost compared to the net book value. Other than that, there are also financial practices and long-term versions where they expect the business to be sustainable.
Going concern assumption is an accounting principle that assumes a business will continue to operate for the foreseeable future without the need to liquidate its operation. Johan and Zizan expect the business to continue operating in the foreseeable future. The business record assets at historical cost instead of liquidation value, indicating there is no intention to shut down or sell off assets soon.
Now let's talk about faithful representations. Faithful representation is an accounting principle that requires financial information to accurately reflect a real financial position and performance of a business. It ensures that the financial statements are complete and free from error to provide the users to reliable data for decision making. This prevents overstating asset values, ensuring the financial statements that provides a true and fair view of business financial positions.
Relevant is one of the key qualitative characteristics of financial statements, ensuring that financial information is useful for decision making. Relevance means that the financial statement provide meaningful and timely information to help users make informed decisions about business. These include investor management and other stakeholders. Why does relevance matters? Accurate and relevant financial data helps businesses track their performance, plan for the future, and make strategic decisions. Without relevant information, decision-making could be based on outdated or incomplete data. For instance, when a business records credit sales at the time carpet are delivered, it can help in assessing revenue trends and financial performance. This allows the company to understand its sales patterns, predict future revenue, and manage cash flow efficiently.
So let's take a look at the final appropriate qualitative characteristics, which is understandability, where financial transactions record systematically, making financial statements easy to interpret. For instance, the uses of the accrual accounting ensures that the revenue and expenses matched properly, improving clarity of the financial statements, which can easy to interpret. So that's all from us. Thank you.
Comparability is the degree to which financial statements from different companies are similar and can be easily compared. The business consistently applies accounting practice such as recording assets at historical cost and applying depreciation. This allows for financial comparisons over different periods.